with so many people sort of obviously managing properties, and we're a big fan in terms of getting a property manager to actually assist with the management and obviously managing the relationship with the tenant as part of that. You know, in terms of engaging a property manager to rent their property out and basically try and seek a return, what's the advantages of that, and do you think that they help in respect of the types of support they can give in recording the claimable items?
Look, good question, Ben. I think from a tax office perspective, what we say is how people structure their investments and manage their investments is their personal decision, and they should seek advice from others, not us. We're here to tell them what the tax consequences are and tax advice. But record keeping is key. So whether you're using a property manager or you're not, you need to make sure that you've got good records to substantiate your claims and to kind of show how you've calculated the amounts on your tax return.
Hey Rob, tell us a couple of examples where you've caught some people maybe two people who have got an investment property together, but they've gone, let's just report all of the income and expenses on investor A and ignore investor B, or vice versa. Can you talk to us about what that looks like and maybe straightening up on if that's okay?
Yeah, Bryce. So that is another common error that we see, is where a property is owned by more than one person, but only one person reports the income and expenses. And so all owners are required to report the income and expenses consistent with their ownership in the property. Now, you can have tenants, you can have ownership in common, you can have joint ownership. There are legal differences, so you do need to understand those, and then working out what your tax compliance obligations are. And there's information on the ATO website in our investor toolkit that helps you to understand, based on your ownership structure and how you own that property, as to what you need to return in your income in terms of income and expenses.
That might have just ended the party for some people, Ben, where they just go, "Oh, I'm earning too much income. We'll put that on the other person's one. No, it has to be whatever's on the title or whoever's the legal owners. You've got to declare it in the appropriate proportions." Another thing that, and we've talked about this previously on our podcast, Rob, but it never hurts to have a nice little reminder here. But the difference between a repair and an improvement, and the fine line, the delicate dance that is often made around the definition of those two things.
Yeah, right. So this is another one, and actually this year is one that we is probably, in terms of rental properties, one of our main messages to investors, is to understand the difference between repairs and maintenance. So you spend money on something on your property to repair, replace, or improve something on your property, and we see people mistakenly think, well, I spent money on my property, it's I can claim it this year, the whole amount. Claim it immediately, done and dusted. However, expenditure can actually be an improvement, and so it has to be capital in nature, or you could have purchased a depreciating asset. So it could be any one of these things, and if it's not the first, being an initial repair, then you do need to claim that expense over a period of time, depending on whether it's capital or a depreciating asset. So a really easy example is few cracked tiles in the bathroom. You replace the tiles, done and dusted, few tiles, repair those in the bathroom, repair. You decide to renovate the whole bathroom because you don't like the cracked tiles anymore. That's an improvement, and you need to claim that over a period of time. So this is kind of the difference. There's a lot of these, and there's some really good examples in our investor toolkit to help people understand this difference between what's a repair and you can claim straight away, and what's something you need to kind of claim over a period of time.
Rob, is it kind of like getting it back to the way it was is a repair, and making it different to the way it was is more likely to be improvement? I know it's not definitive, but just to give our listeners a bit of a guide, just getting it back to status quo, repair, any changes is an improvement.
Yeah, so if you're essentially, Bryce, if it's to bring it back to its basic functionality, it's a repair. Anything more is going to be an improvement, or if you're replacing a depreciable asset, such as an air conditioning unit, that's not immediately deductible, and you need to be deducting that over a period of time.
And Rob, obviously, the other thing that we also might be confused about as investors is the timing of when we potentially fix, repair, replace, upgrade, and whether those deductions are applicable. So, an example might be that when an investor buys a new place for rent, and they've bought something that might be a bit of a reliable and durable, but needs a bit of repair work done or some upgrading done. When those repairs are needed before the tenant moves in, what are the consequences of doing those types of repairs before moving the tenant into the property?
Really good question, Ben. So those kind of repairs are called initial repairs. So initial repairs are different to normal repairs because you're not fixing something that's kind of been damaged or just worn out by the tenants. So repairing damage that existed when you bought the property, whether you do that at the time of buying or later on, down the track, is likely to be an initial repair. And in most circumstances, that expense is considered to be a capital works deduction. And so generally you can claim 2.5% of the expense over 40 years. Unless it's secondhand assets, then there's some other rules. This is why it's worth having a look on the website or engaging a registered tax agent if you're not sure. But the other thing to remember is capital works and capital allowances can also be factored into your capital gains tax calculations when you sell. So once again, really important you have good records, and then that way you can make sure you're claiming what you can every year. But then if you go to dispose of the property, you've got all the records you need to make sure you're calculating your capital gain correctly.
Ben, that might have been a little sleepy one for some folks too, because you go, okay, the difference between a repair and maintenance, got it, or an improvement, got it. But then you go and sneak that one in, and it says, well, if you didn't have a tenant in place and it was in place before you bought it, that actually has a new set of rules. So I think that one's
kitchen cupboard doors broken or hinges aren't working properly, and you're thinking you're doing the right thing so you can attract a good tenant. But ultimately, you might have an initial repair as opposed to an ongoing repair.